Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Daniel Cocca. Daniel is a New York corporate attorney by trade, and he co-founded Alpha Investing, a private capital network that connects investors with institutional real estate private equity investments. As a firm, Alpha has invested in over $4 billion of real estate assets. And in just a minute, we're going to speak with Daniel about some of their investments and how they go about investing at Alpha. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Daniel. Welcome to CRE PN Radio.
Thanks for having me on the show, Dan. Excited to be here.
Well, I'm looking forward to our conversation today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, absolutely. So I came out of law school, arguably the worst time you could possibly come out of law school in 2010. The market had more or less crashed. I was a corporate attorney, or slated to be a corporate attorney, and the credit markets were basically shut down. The IPO markets were non-existent, not the best time. That being said, I found myself in a really interesting high yield debt practice, working on a variety of these small to mid-market transactions. In that space is, you're probably looking at, $200 to $750 million, debt offerings, which seems like a lot, but in the grand scheme of that world, not all that large. And then, over time, as the credit markets opened up, the IPO markets started to get more active, worked on more of those types of capital markets transactions, was a security lawyer. At my core, I never really had the lawyer mindset about me. It was a fun job, a great experience, a lot of really interesting transactions and people and personalities. But I was much more interested in, kind of building my own firm. And I headed over to another shop called Goodwin Procter, another law firm in New York City. And they had a pretty well-established, what they called a technology companies practice, but was really a venture practice, right? And so I started representing a lot of very early stage companies. And that's kind of the point where I met my co-founders at Alpha, and we started to kind of hash around this idea, because all of us were in this position where, we were high earners, right? I think they call us Henrys, high earning, not rich yet, right? And so we were trying to take our money that was, pretty much parked in the stock market, our investing portfolios, and get it into real estate. But we wanted to do it with, institutional, very experienced and seasoned owner operators. And unfortunately, we weren't in a position to write, 7-figure checks into these transactions. And so we were looking for a way to, basically get the best of both worlds, right? High caliber operating partners and low minimums. And, this all happened kind of on the heels of the Jobs Act in 2012, which led to, real estate crowdfunding really starting to become popular. And when I was at the law firm, I saw a lot of those real estate crowdfunding fintech platforms really start to get off the ground. A lot of them, financed by venture capital. And good and bad to that. They definitely broke down the door. They got people as a whole very excited in real estate investing. There was finally access, because, we all know historically it was a country club, friends and family, right? If you weren't writing 7-figure checks, you had to find the smaller, more local operator that maybe you knew, or your friend knew, or your colleague knew, and that's how you invested. And, your options were just very limited. And that's why as a country, we are or have been massively underallocated into real estate. Just the access didn't exist, right? And these platforms popped up, and all of a sudden there were these big marketplaces where you could look at transactions from hundreds, if not thousands of different, real estate sponsors, owners, operators, and potentially invest in them if you wanted to. And, in theory, that's a really good thing. The challenge, of course, is that, a marketplace concept benefits the sponsor side and the people putting those deals together much more than it does the investors, who are kind of forced into this weird world where they're term takers, but forced term takers, right? A deal pops up, you got 3 hours. If you don't say yes and commit your money in 3 hours, you're out, right? And listen, I've been doing this for a while. I can't underwrite a real estate transaction in 3 hours. I think most people probably can't. And so it created this weird set of rules that didn't really work for investors. And that's where my partners and I decided, hey, let's start alpha investing and create something that's really designed for us. We were working professionals at the time. We said, hey, we want to invest with top caliber groups, but we want to do it in a way that works for us. And that's effectively what we've done. I can obviously talk a bit more about the specifics of alpha, but that's my story, leading up to the last, 7 years of my life now.
Oh, awesome. I love the, kind of the background story on my guests, and yours is, clearly kind of a timing thing, like you said, when you entered the law practice and just the economic cycle we were in, and I think it's really key, and you kind of hit on it. And I know that a lot of what we talk about and how real estate is invested in now is central to the Jobs Act. It's funny. I remember that, but I don't always think of it that way. And I appreciate you bringing that up, because that really did kind of, open the floodgates as far as the opportunity for, non-accredited or even accredited, but just be more of a public, known opportunity kind of thing. So I appreciate you sharing that. So let's talk about this. So you knew you wanted to get into real estate. It sounds like you also knew you didn't want to be dealing with small, less professionally managed opportunities. So how did you frame your kind of go forward point, or when you guys started Alpha? What was it that you guys were looking for? What were the types of opportunities or the properties, the asset classes that you were looking for?
Yeah, for better or worse, as I guess at the time I left, a mid-level senior associate at the law firm, I had very little time outside of work, right? We always joke that we often, more likely than not, we would leave the office on a different day than we arrived, right? And so that was just kind of my life. And, I wanted to invest, but the question is, when you have very limited free time, how do you go out and, go through the normal iterations of, oh, I'm going to buy a rental property. Maybe I'm going to buy something. I'm going to fix it up. I'm going to flip it. You just don't have the time. There aren't enough hours in the day. And you always have to remember, hey, my core competency, what allows me to make money and be a high earner, is, not investing in real estate, right? It's, being a lawyer or being a doctor or being a professional, whatever, right? And so that's kind of what we were sitting at. And for us, it was really important to be able to be passive investors and to create an environment whereby I could look at a transaction, I could evaluate it, but outside of making an investment decision and funding my capital, I wasn't obligated to do anything. Now, all the information was available to me. I could pour through rent rolls and lease audits and run scenario and sensitivity until I was blue in the face, right? But I didn't have to if I didn't want to. I could focus on whatever my core competency was. And that was really the impetus for trying to create Alpha and what we did. And I think as we think about, how do we invest in real estate? Our strategy at a very high level, like most high level strategies, is fairly simple, right? We're need-based residential real estate investors. And we believe people need a place to live. People need a place to grow old. That's true in a good economy. It's true in a bad economy. It's true in whatever economy we're in today. None of that should be controversial, right? And we focus on acquisitions of properties that have in-place cash flow. So we're not doing, development deals or new construction. Even though I think those deals can make sense, we want to buy properties typically in that small to mid-market space where we could partner with an institutional operator and buy from a mom and pop, or at the very least, an unsophisticated seller, hopefully find ourselves an off-market deal or a pre-marketed deal, but always outside of whatever value add renovation business plan we may put into effect. We want to be able to reduce the expense side of the financial statement. That's where you create a lot of value as well. And I think a lot of times that gets overlooked because people think about renovating and increasing rents and increasing revenue, and that's certainly important. But these properties all trade based on their net operating income, and so whatever we can do to improve that number is a good thing. And so in that small mid market, which used to be $25 to $50 million assets, is probably more like $70 to $100 million assets today. That's where we think we're able to find those types of opportunities, the ones that we believe create a bit more alpha, and hence the name alpha investing.
I like your kind of the way you broke it down there for the strategy. I mean, need-based. Haven't heard that per se, but it's very clear. A roof over one's head is a need, shelter. And then also how you distinguished, your value add mindset is more to look in a way to cut expenses as opposed to full heavy lift renovation, capital improvement type of thing, which what I've learned over time is that's where you can really make some money, is if it's just a matter of, reducing some expenses as opposed to becoming, too friendly with a plumber, electrician, or a contractor kind of thing. That's definitely a better way to go. So with that being your strategy now, and clarify for me, are you guys taking possession of and acting as an asset manager, or are you looking for others who have syndicated a deal and participating as an investor, or raising capital for that deal? How is it that you guys are set up with respect to a particular property?
Yeah, so we go out and we find what we consider to be best in class operators. And these are the folks that are boots on the ground in any given market. They're the ones that have the right relationships to source these off-market deals. And then they're the ones who are typically executing the strategy that, we kind of come together collaboratively, right? And, our team plays an asset management role. We're going to go out, we're going to obviously tour all the properties and the comps. We're going to underwrite the deal collaboratively. We're going to select debt with our partners, what have you. Our investor network will bring the majority of the LP equity into any given transaction. And what comes with that typically will be control or approval rights over major decisions, sales, refinances, budgets, what have you, right? And that's effectively the role that we play in these transactions. We have maybe 4 or 5 of these operating partners that we work with in joint venture agreements, really on a recurring basis, sometimes more programmatic. But basically the idea is we want to be in long-term partnerships. We're not out there searching for individual deals or transactions to invest in. We're looking for groups that have foundations that set up well for long-term partnerships, because real estate at the end of the day, it's a relationship-based game. It's something we talk about a lot. We joke about, in the public markets, you trade on insider information and you get caught, you're getting fined. Maybe you're going to jail if it's bad enough. In real estate, you just head to the bank, and that's kind of how it works in this space. Relationships are very, very important, and information is very important. These are private capital markets, right? And so that's kind of the game that we're playing. And then we work with this number of groups, and people often say to us, Alpha, like, when are you going to start doing your own deals? Like, you understand how these things work. You put the strategies together, you help find and select the debt, you asset manage, you're on the property management calls, like, you're doing all this work. And the answer is, the boots on the ground is incredibly important. And it's also requires a ton of work that I don't think people fully appreciate. You could fly into a city like Nashville and talk to some brokers, and they'll show you 4, 5, 6, multifamily assets that might be for sale, and they're probably going to be within a few miles of downtown. But all those deals, they're marketed, you're going to pay top dollar for those assets, and they may end up being good investments. But usually the opportunity there is not the same as when, you have someone who can tell you the difference between, the east side and the west side of any given street, right? That's where you really find these embedded opportunities. And for a group like us, we're not trying to deploy capital into 100 transactions a year. We look for 8 to 10 that we think present really well on a risk-adjusted basis. And that's why, being able to minimize expenses or reduce expenses or increase the role of the manager in these transactions is really important, right? That's a risk mitigation measure rather. We're still doing on a lot of these assets, particularly on the multi side, we're renovating, we're increasing rents, we're improving the way the property looks, what have you. But that's all upside stuff. What the other side is really reducing your downside. And when you buy right, you take a lot of risk off the table. And that's one of the challenges in the current value add workforce space, is that going in yields are just so low. Cap rates are in many markets sub 4%. And so your margin for error is not the same when you're buying a 5.5 cap deal, right? And so you need that downside protection in order for these, transactions to make sense.
No, and like you said too, the boots on the ground, the local knowledge. I mean, you can't be more. There's nothing more clear than actually knowing the neighborhood and knowing, the opportunity, or don't buy on that side of the street. I mean, that's. I can't tell you how many times I've had the opportunity. Somebody's presented something, you start looking at it, and something's just not right, and then you find out, why, and it's clearly something with local knowledge you wouldn't struggle to make that decision. So definitely a good point.
One thing I'll say too that I think is important is that when you're a sponsor, you're an operator, right? You develop expertise in one very specific thing, right? If I buy apartment buildings in the Pacific Northwest, I do that when it makes sense to do it. And I also do it when it doesn't make sense, right? Whereas a group like us, we're out there finding these groups, but we're only investing with them when it makes sense. We invested a ton in the Pacific Northwest in 14, 15, and 16, haven't written a check into a deal there in probably 3 years, right? And if we were a normal sponsor where that was our core business, we'd have had to fire the whole team, and none of us would be making any money anymore, right? But the ability to kind of jump around, not just from asset classes, but sponsor partners, markets, even deal types, focusing on cash flow versus appreciation in certain markets, that flexibility is what allows us, again, to go out and achieve that idea of alpha.
No, that makes a lot of sense. As such, your internal structure, are you a fund, or do you have a fund where people invest and then you deploy capital from the fund, or is it one deal, one raise kind of operation?
Investors can participate with us in two ways. We do have a fund that we basically do one every 12 months, give or take, whenever the capital from the prior fund has been deployed. That's a smaller portion of the total equity we deploy in any given year, but it's a product that works for folks who say, hey, like, I want to write one check and I want to get exposure to 6, 7, 8 real estate assets over the next year. I don't really want to pick them out. I'm going to give you guys discretion to do it. That's a model that works well, and I think we'll continue to do that in perpetuity. The vast majority of our capital, probably 80%, give or take, is deployed what I'll call individual transactions. They really are set up almost like single transaction funds, right? So we aggregate the investors in our network who want to participate in any given deal. We create a new investment vehicle where they're all housed. And really the sole purpose of that investment vehicle is to deploy capital directly into one of these transactions. And so, our investors in the aggregate, are writing multi-million-dollar checks. Typically our equity checks are anywhere from $5 to $20 million per transaction, right? But you as an individual, maybe you only wrote $100,000 check, but you get the benefit of tagging along with all of these other investors, and you're getting the same terms that you would get as if you were a much larger investor in these deals.
Got it. You mentioned kind of the recycling, meaning investors, they exit one deal, or I guess a deal is sold, and then do they typically, what's the percentage of persistence as far as your clientele as far as reinvesting in the next opportunity?
Yeah, the significant majority of capital that comes into our network after a sale of an asset is redeployed. So, you get $1 million back, you're going to pay your long-term capital gains, and then the rest of that is likely being reinvested. There are some folks in the network who are a bit older and either in retirement or approaching retirement that are investing to generate cash flow to fund their lifestyle. But I think the vast majority of people in our network, this is capital that they're kind of putting in an account or putting in an investment, and they're just going to keep rolling it over and over and over and over again until they get to the point that maybe they need it down the road, or more likely it's going to end up, being inherited by their children or heirs or what have you down the road. And so the vast majority of capital that's returned comes back into the network. And it's interesting because it does create some challenges, right? When you have a deal sell, and let's say we put $5 million into a deal and now $10 million comes out, and there's a new opportunity that needs $15 million. Well, now there's going to be a massive overflow of capital, right? We have to figure out, well, how do we, a good problem to have, don't get me wrong, but we have to figure out, hey, how do we get all of these existing investors from, the last 2, 3, 4, 5 years, how do we get their capital back into this new deal when we have other investors coming in? And that's a big part of the reason why we've done what many people think is crazy, which is cap our network. We have a somewhat arbitrary cap of 1,000 investors. And we very infrequently let new people into the network. And it's not because we don't like new people. It's not because we have some weird idea that, hey, we don't need more money, we don't want more investors. It's really that we grew this group. It's a private capital network. Everyone who's part of it has been invited by one of the founders or has come in from an existing investor, and they go through a process where they get to meet one of the firm's principals. They do really exactly what we're doing here, just kind of telling each other's story. And we want to make sure those people continue to have access to the projects that we're going to share on a going forward basis, right? There is a limited amount of equity in projects that we think make sense, particularly in this market today, right? And so for us, like, we're happy, deploying, $100, $150 million a year with the group of people that we have. And that's really what we're trying to do. Just kind of build this network and keep doing right by the folks who have kind of helped us get to where we are.
I love the fact that you, just the concept of capping an investment, or the number of investors. One of the things that's always kind of rattled around in my head is more of just that, more is not always more when you're answering to more and more people kind of thing, but to actually kind of foster that relationship and continue to grow together and kind of create more of a community kind of a thing, as opposed to just constantly be out looking for new investors. And I'm assuming that speaks volumes to the work you guys have been able to do and the returns you've been able to provide, and that people continue to reinvest with you and are pleased with the outcome, and the relationships you've created with them, as well as the relationships you've created and maintained with your investor, your syndicators, the deal sponsors. So that's great.
Yeah, I think that's exactly right. When we bring people in, we always say, hey, like, we're going to chat on the phone for an hour and get to know each other. And this may not be what you would typically do with an investing partner, but understand, if you do invest with us, we're going to be in at least a 3, probably 5, maybe 7+ year relationship, right? We hope we're in a 30-year relationship, but at the very least, we're going to be in a 3 to 5 year relationship. And so, like, let's make sure it makes sense today. Let's get on the same page on day one. And the weird thing, or the funny thing, or maybe it's more of an unfortunate thing, is that whole idea is very foreign to most of the people we speak with. It's usually, this business is transaction based. Like, hey, like, sir, ma'am, you want to invest in this deal? Awesome. I'll sign you up. You're in. And that's the end of the conversation. And especially when you're dealing with investors who are not professional real estate evaluators or investors, you just don't know how this space works. There are so many things that come up that people have questions about. People don't understand. Their expectations were off. And that's always the issue, right? If you expect something and it doesn't come true, or it's different than what you're told, that's where you start to develop a bad taste in your mouth. And right or wrong, that's just what we're trying to avoid that, right? And at the end of the day, having the smaller network allows us to have personal relationships with everyone in the network. Do I spend a ton of time on the phone? Yes, I do, right? But it's for the best, I think, in the long run. And it's just part of our model.
Yeah. I'm curious, in the beginning, your fundraising, how did you go about? I mean, clearly it sounds like you've been successful now and you've got a track record and people are referring others to you. How was it in the beginning?
Well, it's funny because we often joke, once we started telling people the network was capped and we were only going to be able to take in a few people a month, like everyone's come out of the woodwork and all of a sudden, wants to join the network and invest with us. Like, where were these people in 2014 when, we're begging every, friend and colleague and former professor to invest $10,000 with us, right? And that's really how it happened. It started out with a group of about a dozen people who, were closer friends, family, immediate work colleagues, mentors that we said, trust us, we think this works. And then the challenge in our business is that you've got this constant chicken and egg problem, right? You have investors, but then you also need investments and deals to deploy that capital into. And when you only have, a dozen investors who maybe are writing on average $50,000 checks, you're looking at $500,000 investments, and that's not interesting to institutional private equity. And so what we had to do was leverage our personal relationships with these operators and say, listen, cut us out a piece of your deal, give us an allocation so that we can go out, build a track record, use it to bring in more investors, show people why this makes sense. And yes, we can only send you $500,000 today. And it's probably going to take us 2.5 to 3 months to pilot together. But we're telling you down the road, we're going to be writing you 5, 10, 15, $20 million checks into these deals. And we're going to have a great long-term relationship. And fortunately, we didn't prove ourselves to be liars and we were able to ultimately get there. But I think it was really important that we set out understanding it has to be a constant balance. There's been periods of time in Alpha where we're saying we really need new capital. We need new investors. We have great deals. We need to get it out there. And there are other times where we say, we have so many investors and we just don't have enough equity for them. We need to pump the brakes. Like, we have to stop bringing new people in. And I think that's kind of the world we're in today, not because we're not finding interesting deal flow, like we certainly are. And again, we're looking for 8 to 10 interesting deals a year. I don't think I could find 50 or 100 interesting deals a year in this current market, at least in the asset classes that we invest in. But 8 to 10 we can find. But when you deal with small to mid-market acquisitions, your equity checks could be anywhere from like 8 to 20, 25 million, in total. And so, there is a ceiling on the amount of equity and capital that can be deployed in any given year. And, because of that, we operate in the way that we do.
Oh, that's awesome. So to date, we're in February of 22 as we record this. How many deals have you seen go full cycle that you guys have been in?
So I think we have invested, I think it's like 57 or 58 transactions. Now, a transaction could be a single property acquisition, or it could be a portfolio, property acquisition, right? We recently started doing a lot of single family rentals. And so we have a lot, the numbers of properties are very high right now. But within the, our more traditional multifamily or senior housing, assisted living, memory care, where we've done a lot of work, I think out of, let's say 60 properties, I think maybe 12 have gone full cycle. We've been in a very, I'll call it very good period over the last 5 or 6 years, to the point that, we actually don't share our weighted average returns because they set an outrageous benchmark, right? And that's not to low key kind of tout our success, say that there's a lot of people have been successful. Rising tide raises all ships. I think that's the phrase. A 20 IRR deal and a sale in 2021 is probably some amount of execution failure. And that sounds crazy. And I hate saying it because all we try to do is benchmark people that you should be happy with 12, 14 IRR deals, particularly if you're getting them in perpetuity. It makes all the sense in the world, but and your listeners know as well as I do, you throw a bunch of 40, 50, 100 IRR deals, out, all of a sudden, a 15 IRR just isn't that appealing. And so we do spend a lot of time trying to make sure we're framing the people in our network. And another reason why having a smaller private network is important, because we actually get the opportunity to explain to our investors and get feedback about this is what we're doing and this is why we're doing it. We're not marketing to people in our network, right? We're writing strategy white papers, explaining why we're taking a certain course of action. And I think because we get the opportunity to get in front of these people, they know who we are, it makes it much easier for us to actually communicate why we're doing the things that we are.
Yeah, no, I think that makes a lot of sense, is that just having that community that has kind of a sense of expectation and an understanding of the way you operate, and some sort of realistic expectation is key to that. I think that a lot of times the social media and just the wave of real estate right now, it lends itself to everybody's just picking up gold. I mean, there's nobody's having a problem, nobody's struggling. It's all just like home runs, and it's a lot of times it's when you have the problems where you really learn the lessons and kind of course correct and make certain you don't do that again. But that's great. What your due diligence process? You talked a little bit about kind of finding the sponsors and a little bit about deals. How involved do you guys get with the due diligence process?
On average, we spend around 6 months between the time we first meet an operating partner and when we'll start looking at potential investment opportunities with them. And one of the challenges is that this isn't a process where we get on the phone, I send you a 6-page diligence request, and a week later you send me back absolutely everything I need, right? When I was an associate at the law firm, that is exactly what happened, and it was very efficient, and we could churn through diligence on deals in a week or two, right? That's not the case in our space. There's usually a lot of back and forth getting the information we need. And I think it's also important, this is not a space where every operator looks at or evaluates or tracks performance in the same way, right? You may have to go back and look through a bunch of, case studies, models, financial statements to get the data that we need. And the goal is really always to make sure that, the groups we're working with have certain tangible and intangible qualities, right? We want to make sure that they're able to execute. We don't want to take the risk that something's going to get messed up outside of the broader economy or the market, that your renovation pace is going to be off, or you're not going to be able to source materials, or if you plan to refinance the debt on a property in year 3, you don't have the net worth to do it, right? Those types of things are incredibly important, and we're never going to take any amount of risk as it relates to those specific components, right? And then part of it too is just when you send me a document and I follow up with some questions, how do you respond? Are you quick to respond? Are your answers thoughtful? Have you thought through the intricacies and the details of these things in the same manner that we are? If I ask a question to you about, here's your deal and here's your rent premiums, and we noticed this one thing happened that seems inconsistent with the rest of the data. When you say, oh, I need to go back and look at it, that's usually a sign to me that you're not quite as involved in the process as maybe we want you to be, right? And it's always a bit of a balance, because that doesn't mean that group or that person can't be successful. They absolutely can, right? But the folks that we try to work with, and again, it's 4 or 5 operating partners at any given time that we're looking at investment opportunities from. So we don't have to go out and find thousands. A very different standard that we're applying. But we're looking for groups that, we think get it. Like, and we say best in class, we don't just mean you've acquired $2 billion worth of properties over the last 5 years. That's a part of it, right? Experience does matter. But we want to actually believe, from our conversations, that, hey, like you get it. And the stuff that you don't get, you acknowledge it, you explain why you made these mistakes in the past, and give reasons or solutions that you've come up with to fix these things, right? That's a much more important part of the process, and I think a lot of people think about. And that's one of the challenges too, in full transparency, and just being an individual investor who's writing a $50,000 check, right? You can't get 40 or 50 hours on the phone with a real estate sponsor when you want to write a $50,000 check, right? But our team does, because we're writing substantially larger checks, and that's where we really get through a lot of it. And if I met 100 operating partners, this year, let's say, probably, I don't know, 70% of them would immediately be written off the bat. Either they don't have the right experience, they don't have the right pedigree, they're too new, they're in the wrong, sector, they're not doing markets we think make sense, et cetera. And then when you really get into the weeds with that remaining 30, by the end of the year, there's maybe 2 or 3 that you say, okay, like there's some opportunity here, right? And then out of those groups, everything has to kind of align, right? Like we have to find a transaction that we think makes sense, that we think on a risk-adjusted basis works for not just our investors, but ourselves, because we're invested in these deals as well, right? And it takes a while. And so when you find these partnerships, they're long-term in nature, right? Like we didn't invest 6 months building this partnership to invest in one deal with you and then never again, right? And then on the other side of the coin, what's great about being in multiple transactions with the same groups is that I see all your performance data, right? I'm tracking your actual versus your projected every single month on every single asset. And so when you bring me a new deal and we underwrite this transaction, we can feel really comfortable that the numbers we're using, the assumptions we're making, are as close to what should happen as possible, right? And these are projections. They're not, we don't know. Anything could happen, as we've learned over the last couple of years, right? But it does provide a great framework by which we can more confidently underwrite deals.
Yeah, no, it's an interesting balance you have there with having to, continuously search for a new deal sponsor, somebody that you can, deploy capital with, and then also that the investor side of the thing on continue to, nurture those relationships and, possibly look for additional investors. That's a little bit of a balancing act there. So that's great. If we could, Daniel, I'd like to shift gears here for a second. By day, I'm I'm an insurance broker. Also do a little bit of real estate myself, but I work with my clients to assess risk and determine what to do with the risk. And there's a couple of strategies we typically consider as an option. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when neither the avoid or minimize strategy will work, we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. Could be their clients, investors, the market, interest rates, COVID, however you would like to frame the question. But take a look at your situation and try and determine what is the biggest risk. And for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Daniel Cocca, what is the biggest risk?
So I call myself a former lawyer. I guess you're always a lawyer. Risks are near and dear to my heart, right? You'll see 10 pages of risk factors in the documents that we send out. It's something we think about a lot. The oversimplified answer to your question is that we look at deals really with a matrix with two columns. One column is execution. The other column is market-driven appreciation, right? Execution is something that we can mostly control. There are some things like supply chain and whatnot that may fall outside of our control, but usually we can figure out ways to get ahead of the curve on those things. And the partners that we work with, we have zero doubt about their ability to execute. These are not newcomers to the real estate world. These are, tried and true groups with long track records of success, right? And so that leaves the other column, the market-driven appreciation. And that's the real unknown. And there are a lot of factors that go into that. But I think in this present moment today, February 2nd, the thing that we're all thinking about is interest rates, right? And, it was a day or two ago that Bank of America shocked the world and said, there's going to be 7 rate hikes this year. And everyone said, like, what, what's going on over there, right? And it wasn't, though, that long ago, like 4, 5, 6 months where, okay, rates are going to hike up the middle of 2022. Maybe we'll see 1 or 2. And then it was like 3. And then it was like maybe 3 or 4. And so we'll see what happens with interest rates because, as I'm sure your listeners know, the cost of borrowing is a very important component of pricing, whether you're a buyer or a seller, right? And the historical wisdom has been that interest rates and cap rates move together, right? Meaning, interest rates go down, so do cap rates because your cost of borrowing goes down. You can pay more for a property, right? But what we saw in 17, 18, give or take, especially during that period of time where we had 7 rate hikes in 8 quarters, was that really wasn't the case. Rates were going up, but cap rates were still compressing. And I think what a lot of people concluded is that there's a lot of dry powder in real estate right now. Some of that is from the crowdfunding world. A lot of that is from just general real estate private equity that has record amounts of money on the sideline. And so the real question is what will happen once rates really start to tick up? Will you see cap rates start to go up? If that does happen, I actually think it would be a good thing, particularly for folks in our position, because we underwrite pretty heavy cap rate expansion into our deals. If cap rates stay flat or compressed, that means a home run, right? Investors, get a ton of proceeds at exit, right? But it also means it's very challenging to redeploy that capital because pricing is so aggressive. And so there's a happy medium where you're getting really strong returns, but then you also have places to redeploy that capital where it makes sense, right? And what we'll find out over this year is, really what happens to pricing. A lot of the deals that we invest into are, floating rate, variable rate debt, right? And people like that type of debt over agency, government Freddie Fannie debt because there are very seldom or very small prepayment penalties, which allow us to exit much faster when you're in a rising price environment, right? But will people then transition to longer term fixed rate agency debt again? Like that's certainly possible. And so it's a long way of saying not just interest rates, but the response to interest rates is, the biggest risk to this space. The worst case scenario, and this isn't a bad worst case scenario, but it is a worst case, is that rates continue to move upward and cap rates stay flat or continue to compress. Because what that means is that when you're buying a 3.5 cap today, you're buying really a 2.5 cap at the end of the year, right? Apples to apples. And so that just starts to get really uncomfortable. There's supposed to be a positive spread between interest rates and cap rates. And so, if you buy it at 2.5 and, you have 4.5 or 5% debt, even a cash flowing deal effectively looks like new construction, right? Because there's no cash flow in the first year or two, and you're basically making a bet on the residual value. And so, long answer to your question, probably not a particularly unique answer, but in this moment in time, February 2nd, 2022, interest rates and pricing response to the interest rate change, that's the biggest risk that I see.
Yes, stay tuned. We will see where it goes, but yeah, I think you're right on that. As much as a lot of people are, kind of thinking the same thoughts and waiting and see just exactly how the market responds, and we will know when we know, I guess. Um, Daniel, where can the listeners go if they would like to learn more or connect with you?
So you can check us out. Our website is the letter I.com. We have a lot of information on there to share with potential new members. If you're interested in joining, you can please feel free to request access. Mention, you heard me here today. In full transparency, we're not admitting a ton of people to the network right now for the reasons we talked about today. But we do have a pretty lengthy wait list. We're happy to chat with people who seem like they could be a good fit. And we're always happy to make connections and introductions. We're people too, and we're always trying to be helpful. But that's where you can find more about us.
Awesome. Daniel, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thanks, man. Appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Networks, CRE PN Radio.